Well, welcome everybody, and thanks for joining us again for today's call, a market update webinar. We're going to give folks just a minute or so to join in and make sure everybody gets connected. And our last one of these was, I believe, on June 13th. So a lot has transpired and a lot to update everyone on. Just some housekeeping items. If you have questions or you want to send us a comment, please do so. It's probably best to do that through email, and you can email Mackenzie, that's MACKENZIE at myatlanticwealth.com, and she'll make sure we get those questions or comments. If you have anything related to today's discussion, again, feel free to email it on to her, or if you just have questions or concerns about your accounts, please send either JA or myself an email. We'll be glad to speak with you about that. So these are a good way that we can communicate with clients and friends and just keep folks up to date. I know it's a really concerning time in the markets, and folks have been getting statements from June. So, you certainly have every right to be concerned by values. We hope today we'll be able to share some current information, give you our thoughts, and just talk through the issues of today, and help everyone see what we're thinking and where we think markets are going. So with that, let's just go ahead and dive into the agenda today. Much like last time, we're going to talk through current market returns, just take a look at the equity markets in general. We're going to take a look at the latest economic data, which would include the U.S. recession indicators. This is a dashboard of indicators that we follow. We think it's important to keep you up to date on these as they change, and there have been some changes in them. We also want to talk through leading economic indicators, and we'll be doing so. These give us a forward look into what we think the economy is going to do. And then we're going to go over just a general economic update that includes midterm elections and the volatility surrounding them. And we're going to take a look in the rearview mirror at previous midterms going back 60 some years to help provide some perspective around what we think we're going through right now. And then we'll conclude with just some thoughts on the economy and what we think you should be doing today. So with that, let's jump into the S&P 500. This gives you a look at year-to-date results from January 1st to today. This was done this morning at around 10. We're right now in the 3830s on the S&P 500. We had a slightly negative week last week, and we started off positive today, but have since drifted downward. For the year, we're down about 19.5% on the U.S. equity markets. And the S&P, the Standard & Poor's 500, is simply the broadest measure of equity performance or stock performance for the U.S. It's probably the best benchmark to use as it looks at large cap companies. So that's the one we take a look at. Let's shift that to just the past month. We saw some lows around the last time that we spoke, and those were around 37.49 on June 13th. And so we're up about 2.25, a little over 2% for that last month almost through just the last few minutes I took a look at the market. So it has trended positive somewhat, but has been volatile nonetheless. And if we take a look at it over a longer period of time, which I think is most helpful for the long-term investor, we can see returns over 55% over the last 5 years. Taking a look back to 2450 was back in 2017, I believe it was. And you had some big returns to the negative in 2019, as well as March of 2020 with the onset of the pandemic. So even in spite of those time periods, one recession that was 2020, we've still seen markets over that time period trend positive. And generally, we can expect 2 negative years of stock market performance out of a decade. And we've seen that hold true. We're not sure how this year is going to end up, but it certainly looks that way from the mid-year results. So let's take a look also at the NASDAQ index. Tara's going to talk us through that.
Yeah, I'll take over with NASDAQ. So when I say NASDAQ, what I'm referring to here is the NASDAQ Composite Index. This is comprised of about 3,700 companies or 3,700 stocks. These companies are heavy on technology. I know you guys are familiar with companies in the NASDAQ, well-known large companies like Apple, Microsoft, Google, Meta, Facebook, and Amazon. So this first chart that we're going to take a look at is year to date. And so what we're looking at right now, from at least this snapshot, might be down a little more, about 27%. Mid-June, just like Greg was talking about, the S&P 500, we did see a bottom. Don't know if that's the ultimate bottom for this year, but we saw a bottom and then trending up. And you can see we've circled it here, and the NASDAQ was down to 10,600. And then here's where we are today as of Monday, July 18th. And then just a little bit different view. This is the 1 month. Again, we have circled here whenever we had a low point. So the low point I was referring to was a little bit earlier on in the year, but for this 30-day look, here's where we are today as far as for June for the NASDAQ.
All right, I'm going to jump in now just to provide some an update of the latest economic data that we've seen over the last week or so. That first bullet point, the Fed, I'm going to say for last, and I'll start with employment, excuse me, which we saw the June numbers come out Friday before last, and they were very positive. They were ahead of expectations in terms of number of jobs gained. They were in the 372,000 range, and expectations were around 265. So it was another positive jobs report, which we've seen over the last several months. So that's kind of a bright spot in the midst of a lot of negative news that's out there that we're also digesting. The unemployment rate remained at 3.6%. So that's a very low unemployment rate. And we saw that earnings were up, or wages were up a little over 5% versus a year ago. So 5.1%. All that data was in the employment report. Of course, wages are not keeping up with inflation, and that brings me to the CPI, Consumer Price Index data that came out last week on Tuesday. And we saw the CPI jump up over 9% year over year. So it was at 9.1%. Just to provide some perspective on that, we started the year at 7.5% on the CPI. We jumped up to 8.5% in March. April, we dropped back down slightly. So there was some thoughts that maybe we had topped out in March, and then we came back in May at 8.6% and June at 9.1%. So we've definitely seen market reaction and Fed reaction to those CPI numbers. I know Greg's going to talk about that, but the report last week, again, the headline CPI was up 9.1%. There's a core CPI that's a piece of that headline that takes out energy prices and food prices. And that core has actually been down over the last several months. But as we all know, energy and food are part of our everyday lives, right? We all go fill up at the gas pump and go buy food at the grocery store. So that's been the driver of the increases, really, from an energy and food standpoint. The PPI, the Producer Price Index, came out last Wednesday, and then we saw an increase again in that. Unlike the CPI, which hit a new high for the year. The PPI, it wasn't a year-to-date high. That was back in March. We were at 11.6%, but we hit 11.3% in June. And the trend, again, I think some folks were hopeful that after March we'd seen a decline. We dropped under 11% at the last reading. So, to go back in the opposite direction is not encouraging. But again, these are input prices at the producer level. So things like gas and food prices, those types of things have driven up the PPI, similar to the CPI. We do kind of focus on the PPI as somewhat of a leading indicator for the CPI. And there is a core piece to the producer price index as well, which we've seen a similar trend in the core coming down if you take out energy. But again, energy is a reality for everyone, not just consumers, but producers as well. Retail sales, we saw that updated data come out for June at the end of last week, and we saw sales that were positive, that were ahead of expectations. So we saw a year-over-year gain of 8.4% in retail sales. If we compare that to the CPI, the inflation index, still not keeping up with inflation at 8.4% versus the 9.1%, but it was at least positive and it's close. That tells us that folks are continuing to spend despite the inflation that we've seen, albeit not keeping up exactly with the pace of inflation. But by and large, I would say, from a retail standpoint, that was a positive number that we saw come out. And then the Fed, the next Fed meeting is the end of this month, 26th and 27th of July. And we have seen quite large pivots from the Fed since the beginning of the year. So we thought we were going to take this gradual approach to rate increases. And then when the inflation numbers came out, we've seen consecutive rate increases, increasing rate increases. So, the last one was at 75 basis points. Time before that was 50. And they said with the 50 basis point hike that they were going to continue on probably at 50 basis point hikes, but their tune changed when the data came out. So again, I know Greg's going to touch on that, but our next data point on that is going to be the end of this month, and everybody will be watching that. I do think with this latest CPI number that's come out and the data and the articles that I've read, the commentary, there was some thought that we may see a 1 point increase. I think that's been tempered a little bit, where probably the consensus now is that we'll see a 75 basis point hike again in July. So that just catches you up a little bit with the latest economic data. And that brings me to this question: what exactly is a recession? So we've talked about the R word before and how that's entered the news media quite a bit this year. And so how do we define a recession? Actually, it's the National Bureau of Economic Research that defines recession. They don't define it, contrary to popular opinion, as 2 negative quarters of GDP. But I'm going to take a second just to read through this definition. They define it as a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. A recession begins just after the economy reaches a peak of activity and ends after the economy reaches its trough. So the NBER is really the arbiter of when we're in a recession, when we're not. And, we had a first quarter negative GDP number come out, we'll be awaiting the second quarter numbers that will come out at the end of this month. But when we look at the things that are stated here and that are looked at from that recession analysis by the NBER, we really don't have recessionary flags around some of those top four areas. From a consumption standpoint, we're still close to peak. Payroll is close to peak, personal income close to peak. It's the manufacturing sales where we have seen declines, still growth in a growth mode, but we've seen declines off the peak there. So that provides some color into, what really is a recession. We're not here today to call when the next recession is going to take place. We will say there will be another recession. We will all go through another recession together. There's question marks about when that will be. And there are real risks out there right now in the economy that we are paying attention to. And so that brings me to just this recession risk indicator dashboard that if you've been with us on previous calls, we have taken a look at this each time and updated based on the latest data. This just shows you back over the last 4 months. There are 12 kind of recession risk indicators that we pay attention to in this dashboard. You can see there was some more green, which indicates expansion if we look back to the end of March versus the end of June. And you can see how there have been some changes across these indicators over the last few months. Specifically from our last call, we've seen retail sales go from an expansionary indicator to a cautionary indicator. And we just talked about the retail sales report, how it's positive, but it's not keeping pace with inflation. So that's hence the cautionary signal there. Wage growth has had a negative recessionary signal for quite some time, again, because wage growth is not keeping pace with inflation. We did see from May to June that ISM new orders, so that's kind of a manufacturing measurement, and that has declined. Again, still positive in a growth mode, but it has declined off highs. So we have a cautionary signal there. And then we saw credit spreads change from yellow cautionary to red. And that's just due to this environment of tightening we're in with inflation and the Fed continuing to raise rates. So that kind of gives you kind of an update on this dashboard that we've taken a look at before. If we look at it from a longer term perspective, you can see these other columns outside that first current column just show other times when we've been in recession and how these different variables have really significantly turned red when we are in recession. So we do have about half of the variables that are no longer, or that are not green, that are either yellow or red. So we are, paying close attention to the data as it comes out and monitoring it.
All right, I'm going to give us an update on LEI, which is the leading economic index. The Conference Board produces this each month, and we eagerly await. This index has 10 economic components. Not going to go through all 10, but just to kind of give you an idea of what some of those are. Consumer sentiment or expectations, the S&P 500 index, and also unemployment applications. So what we can use this index for is just to plan around expected performance and shorter term performance in the economy. So June's release of the LEI, and June's release kind of caps out at the end of May. We did see a decline, and that decline was attributed to falling stock prices, which we all felt, a slower housing construction, and a lower consumer sentiment. With all of that being said, the index is still historic highs. We still see expansion, just maybe a slower expansion or slower growth. That takes us to just take a look at longer term trends. And what you're going to see on this chart is the blue line just plots the LEI over time. You do see an increase, but of course there's periods of, well, I'll call it volatility. The backdrop here, the gray lines that show periods of recession. So you can see when they're overlaid, that when we have a recession, we have those gray lines. There is a trend of the LEI that drops, but of course our longer term, which is what we're focusing on, it shows upward growth. The next one, Jay, you want to go ahead and hop on over to the next one. This is just another view at the LEI, which is on a closer scale. So for this chart, before we were looking back to the 1960s or even into the 50s. This one, we're starting at 2000 and pushing out today, 2022. And this shows a year-over-year percentage change in the LEI in comparison to the percentage change in real GDP. We still see the backdrop here as periods of recession. And so this recent trajectory of the US LEI has slowed, which points us to slower growth in the near term. This appears to be moderating, or another term that I've used is a more normalizing in the economy.
All right, so this is our picture of the day, and there's really a lot I could say about this. And I think this is appropriate for where we are in the cycle. So the big guy coming off the top turnbuckle there is our representation of the Fed, sort of in midair. The economy, while he's not out for good, he's just sort of laying there. The Fed's getting ready to land on him. And really, if you go back to even just last year, the Fed had a stance of, and in fact, they were quoted as saying, well, we're not even going to think about raising rates until the end of 2022. And as J.A. pointed out, that changed early this year with the first hike in March. And the thought there was that they would raise 5 or 6 times, I believe is what they said, and have a moderate approach to that. And it's turned out anything but, simply because the inflation data has remained hot, and that's coming off of the CPI, Consumer Price Index, which just came out last week, a little over 9.1% last week. So the interest rate hikes by the Fed have not really done anything to cool off prices rising. Although lately, I would tell you, we probably all witnessed a little bit of a drop in the price of gas at the pump. So, this March 16th movement that they made was a 1/4 point rise. It was the first in 3 years since December of 2018. And, I think it's significant that the guy coming off the top rope has got a lot of color to him on his I guess that's his uniform or outfit. And the Fed has been certainly colorful and taken the lead of the day as they try to slow down this inflationary pressure. The current prime rate is at 4.75%. It's up from 3.25 in March of this year. And so we think there's still more to come from the Fed, and that will be, we'll look at this at the next chart. Jay, if you'll flip it over, this is kind of a look at the core CPI results looking March 2021 to May of 2022. And it's just survey data from the University of Michigan that shows consumer inflation expectations, what the consumer is thinking about Fed rates and the difference between the two. And so the chart on the left is showing that increase, and the chart on the right is just a historic picture from 1990 when the prime rate was 10% to where we are right now. It's a trajectory that's coming up. The preliminary data in May was at 3.3% difference in the two. So definitely a pivot from a more dovish stance just a year ago where they were clear on not raising rates to a Fed that started this year with a more hawkish approach to that. So as Jay alluded to, core CPI peaked in March at around 6.5% and has since trended down. This is X food and energy prices in that index. So it's, you know, it's one way to look at it. I think the news might quote that more, but we're looking at total CPI as we look at these indicators. And then if we take a more, I guess, a historic look at the Fed and what that looks like over time, we can see this chart, and there's a lot to this, but let's just take a look at the far left-hand side of the chart. If you can find in that top left-hand corner in red letters, it says 2022 estimate at start of the year, and it has a gray dot under it. So what you're looking at here is the December 31st estimate of how much the Fed was going to raise rates. And at the very bottom of that chart, it's listed at 100. So 100 basis points or a 1% move in interest rates. And we knew that inflation was around 8%. Follow that to your right with the teal dot. The first hike was in March. And of course, they changed their tune to around 250 basis points. And then our current estimate right now is moved again to the right as of June 30th to a 350 point base case from the Fed. That dotted line that's going from bottom left-hand corner to the top right-hand corner is the trajectory in previous years of the Fed. The CPI at first rate is on the left-hand side, going from bottom to top. And then along the bottom is the actual movement from the Federal Reserve. They're tightening in the first year of that hiking cycle, as we call it. And basis points, if it's 100 basis points, it's equal to 1% rate rise. And so on the far left-hand side, you see 2015 and 1963. And the far right-hand side, this is beginning to feel like it's more closely aligned with 1980. And so the Fed, I can tell you what they're trying to do is to keep inflation down and to bring it down. They've got the employment part of the mix squared up, especially after 2020 when we saw unemployment rates really spike pretty quickly. And so they took matters seriously there, but the economy has just become overheated from a number of factors related to the pandemic and the after effects thereof. So our thought is that rates continue to hike pretty aggressively until we see some movement of inflation to come down. And so, the Fed releases their results next week on the 27th, and the consensus is it'll be a 75 basis point hike or 0.75%. And we'll see inflationary data show up mid-month in August to see if that has made any impact. And so I think these are the two headwinds that are impacting investors today more than anything. And it's really shown well in this chart. So there we go. I think Jay is going to talk about the 10-year Treasury and how it's impacted from this as well.
Yeah, before I move on, I did mean to mention, you mentioned it, Greg, we have seen some alleviation in gas prices in July, right? To start, since we're halfway through the month, basically, a little over halfway through the month. So it'll be interesting to see what if that continues, and if we get, if it does, it probably will have some impact on the next CPI, PPI readings that come out next month. So stay tuned on that. As far as 10-year yields, this is a chart we've looked at in these updates, and there's been quite a bit of change and movement in it since our last call. So if you look back about a month ago in mid-June, we were close to 3.5%. We've dropped back down under 3%. That mid-June was coming off the CPI number, and then there was a Fed meeting right on the heels of that. where they raised rates to 75 basis points. So, you know, we've talked before about how the market tends to overreact one way or the other in the short run, and then moderate and normalize out over the longer term. I think that we may have seen some of that with the jump up to 3.5% and now back down in the 3% range. But you know, it is, the 10-year yields are something we pay attention to and look at on a regular basis as indicators to where we're headed, and a rate that impacts the fixed income market and pricing in that too. Okay, the title of this slide is A Case for a Soft Landing. And so the reality is that we are in a rate hike cycle, a tightening cycle. And if we look back over the last 13 Fed tightening cycles, 10 of them have ended in recession and 3 with soft landings. So some of you may hear that and be like, well, that's not too good odds of having a soft landing if 10 of them have ended in recession. And you are correct just from that cursory observation. But when we look at the 3 time periods in which we've not ended in recession with rate hikes, you can see the comparison here for those 3 time periods versus currently. We've hiked rates 150 basis points year to date. We expect more of that to continue, but on average, you can see the last couple have been in the 300-point range in terms of hikes. The real thing to zero in on is the job market. And so this payrolls number that shows here currently, we're at a very high numbers from a job market and payroll standpoint. So we see that if there is going to be a soft landing and we're able to avoid recession, or even just having a mild recession, then the strong labor market does provide somewhat of a path to having a slowing economy without a recession. And just some further analysis with regards to the labor market and whether or not it will bend or break. That's the title of this slide here. The 2 things that these charts are focused on are job openings and wage gains. And you can see there with both, there have been definitely moderation and potentially a rollover in the trend on those 2 items. And so, you know, if we're able to have reduced labor demand and thus reduce wage growth, but not have a substantial pickup in unemployment, then, you know, that could be a path to staving off recession, or at least minimizing the impacts of a mild recession. Next is just the manufacturing index, the ISM manufacturing survey. And this is something that historically has provided, it's been a leading indicator of economic activity and specifically earnings. So that becomes a question as we look at recession and, well, are we going to see a deterioration in earnings? We are coming off of record earnings in the not too distant past. So you can see the gray line there. We have seen the manufacturing index turn over, and the trend has gone to declining index. I think I mentioned before that it's still in the growth territory, but it has declined off of highs. So question is, coming off of record earnings, we do expect some deterioration in earnings. How much of a deterioration is going to be the question? And may potentially, you know, with us coming off of the recovery from coronavirus and having record earnings, you know, does that make companies more able to withstand, you know, a decline?
Okay, next is bear market, and just putting this into context, we are officially in a bear market. Just wanted to show you this compared to other times in which this occurred. So over on, we have start dates and then of course end dates, the duration, which how long we were in a bear market, and then next is percentage change. And so start date was January 2022. We don't have an end date at this point. We'll know that after the fact. So this was updated as of the end of June. So 6 months currently as far as a duration, and the percentage change is down 23.6%. And so you can just see that in comparison to other years and timeframes when we've gone into a bear market. The average is 16 months, and the average decline is down 35.1%. I think some things to highlight over here is not every time we go into a bear market is there are a recession. Sometimes there is. If we're in a bear market, we enter to a recessionary period, the average duration is around 17 months, and the percentage change on average has been negative 39%. For other times in which we've had bear markets, there has not been a recession, the average duration is still over a year at 13 months, and the percentage change is at 28.2%. And just the note down here, it says that, the first start of the year has been severe or painful. But as far as bear markets, we're still, as far as duration, in a shorter time frame as of right now.
Yeah, and I think it's important to note this is 100% equities. So just looking at the US stock market.
Right.
And so what's been most concerning, I think, to us is that fixed income markets have also corrected to the downside due to rising interest rates and the inflationary data. So we've made changes approaching this year and even in March, where we have adjusted fixed income markets, but there really hasn't been any place to seek shelter in what would traditionally be a conservative investment.
Mm-hmm.
When you think about a bond, for example, you think about return of principal, a fixed interest rate, and a pretty stable price, unlike an equity market where you would expect it to sell off during this time period. So this is very similar to us as coming out of 1980 and the 1981 recession. So I wanted to talk about valuations as well, just because I think it's on everybody's mind. Are we overvalued in the stock market? Is now a good time to add money? Those types of questions are ones we're getting. And so what this chart is showing you, looking left all the way to the right, your far left is October of 1966. That recession or market bottom, as it may be, the valuation was at 13.4, 13 times earnings on the S&P 500. The average has been 11.9. We're currently at 15.8, which is down substantially, but it's still above the average. So over the last 20 years, major market lows have tended to occur at loftier valuations, so over 14.4. And so we still think that there could be some equity valuations that are higher than what that average is. And certainly these time periods, as Tara mentioned, we're in a bear market. They do tend to reset valuations, as do corporate earnings coming out. So it'll be really interesting to see how this starts to look. I know Bank of America has released their earnings, and their net income was up. So as companies continue to release that, we'll keep you guys updated. But this was just important, I think, to see where we are in the overall value of the stock market.
Yeah, and I think if we look at the beginning of the year, we were at 21 plus times earnings, so we've dropped quite a bit. And this chart shows the average PE ratios in bear market bottoms, but if we looked at average PE ratios just in general, we're back down to underneath historical average PE ratios.
Right. Yeah, and again, it's tough sometimes to wonder when the best time to invest is, but it's usually our thought and our advice to invest when you have money available and it meets your goals. Timing the market is tricky at best. Simply, the comments we've made leading up to this slide around what the Fed said they would do and what ended up happening. Of course, at the beginning of the year, nobody knew Ukraine and Russia was on the horizon. As of the 1st of March, that was a real issue and continues to be a concern. Supply chain issues have not worked out as quickly as they thought they would. But what we want to show you by this slide is looking left to right, 1930 to 2020. We believe we're in a secular bull market. These tend to last 15 to 20 years. A secular bull average drawdown is 26%. So we did hit bear market territory about a month ago. And we think that the stock market is making a correction, but does have the secular bull trends to it, which means it would run several more years to the positive. And we've seen time periods like 1950 to 1970. There were 365 all-time highs and a 451% cumulative return. And that tended to repeat itself to the better in 1980 to 2000. Then we had the correction in 2000, 2001 and 2. Of course, the economy was pretty bad. It seemed like it was more in the tech sector, but it did end up bleeding over to all sectors with the September 2011 issues. And then of course we saw the major recession of 2008 and 9 with a cumulative return of negative 24%. So we believe there's some great opportunities in the midst of the selling and the concern we have around inflation and interest rate rise. But we also believe that we're in a secular long-term bull market that still has some room to run. And the Fed, what they're doing with a strong labor market backdrop and a strong consumer should work to bring down inflation. It certainly is stubborn and looks like it is not transitory, which is what we were all told last year. But we think that it will work over time. So that's our thought based on where we are right now at this point.
Since it is a midterm election year, we'd like to discuss that and just show you historically how the market has performed around elections. And so this chart takes us back to the 50s through the last midterm. And on average, this is the key takeaway on this slide, is on average 12 months after the elections, the stock market has been up 15.1%. So some years you can see higher and some years lower, but that's an average. I think even more interesting is that every single midterm election, 12 months after, so we have the election 12 months after we take a snapshot of the market has been up or has produced a positive rate of return. So this is something to keep in mind as we approach the fall.
Yeah, I like those. Those are interesting stats.
Okay.
And history has repeated itself, right, for the last however many of 70 years or so, from that standpoint, in those midterm or after the midterm elections. That kind of concludes our going through the data that we had to go over with you guys today. Wanted to kind of conclude with a summary of things from an outlook standpoint, and breaking that down from a U.S. economy and then the U.S. market, because they don't always, I guess, they're not always positively correlated. So from an economic outlook standpoint, We talked about the dashboard and how we have seen recession risks rising, and we've got about half the dashboard with either yellow signals or red recessionary signals. The path for a soft landing scenario, we talked through that a little bit, and it is going to be dependent on several things. One of those in large part being what happens to inflation. You know, do we see inflation roll over, and the Fed response to that? And then we didn't touch on this this call, but we have before previously, just talking about the consumer and how the consumer is in a position there's leading into this period of reduced economic growth from a period of strength, coming off of coronavirus, increased savings rates, net worth increases. So is the consumer able to withstand, you know, the inflation and the economic conditions we're faced with? And then elevated corporate margins and a tight labor market could short circuit the recessionary layoff cycle. We talked about that a little bit from a labor market standpoint. So are we able to have, because of the coming off of record earnings and having this coming off of a tight positive labor market, can we get through this period of normalization of interest rates and Fed tightening, inflation without a large layoff cycle? So we will see. I mean, the verdict's out on that. And then the U.S. market outlook. We talked about headwinds, including the Fed and how they've changed their tune because of inflation. You know, what does that look like going forward? We've got midterm elections this year. And so what happens around there tends, as we just looked at, tends to be positive market performance after midterm elections. And then, you know, globally, we've still got the Russia-Ukraine conflict. And I think in general, worldwide, we're dealing with similar issues as we are in the US. So we continue to expect volatility until we see kind of a more clear path going forward. I think we could probably fill in the blank there and say until we see inflation begin to roll over and start to come down. That's probably the biggest variable, because that's going to impact the Fed's response to that and just the snowball effect from that point. But as we looked at as well, that bear markets are rare over time historically, and we don't always think about that. We're in the midst of one. We tend to focus on the here and now and what's happening and what is my value today compared to last month or, you know, the beginning of the year. But they are rare, and for long-term investors, they can be opportunities to put money to work, and so we continue to hold that view. And then the overall dashboard signal, while they are mixed across the board, we do see that the economy, we would expect the economy to continue to grow, albeit slower growth than we've seen over the last couple of years. But the asterisk by that is that we continue to monitor all of these data points. And as we've seen the dashboard change and somewhat deteriorate over the last few months, you know, we will continue to monitor monthly and keep you guys updated on that. And then finally, as we've done these webinars, we'd like to close with some biblical wisdom and truth. And last month, we were in the book of Isaiah, chapter 41, verse 10. So if we look just a few verses down from that, we read, "For I, the Lord your God, hold your right hand. It is I who say to you, fear not, I am the one who helps you." And I think where it's very easy to become fearful over any number of things, there is one place to find peace that surpasses all understanding, and that's with our Lord and Savior Jesus Christ and His Holy Spirit that He gives us to live in us. And so we wanted to leave you with that. That's where we find our peace, and we would pray that for each one of you guys as well. With that, we just want to say thank you for joining us today. We are here to answer any questions or to get together if we need to sit down and talk, to update your goals, or just to discuss further any of these things we've talked about today. So we appreciate the opportunity to serve you. Thank you for your time, and we look forward to catching up with you soon.
Yeah, and it's a special privilege we have to share with you this data. I know some of it can get kind of in the weeds, but we think it's important to share. And also, you know, you're going to get an invitation in the mail here in the next few days that will be inviting you guys to a celebration just to thank you, a client appreciation event. We haven't done this over the last couple of years just due to the environment. The pandemic has made it really difficult to get together, but we feel like sort of the worst is behind us, and we're hoping that you would think that as well, and we could join together in just a time of fellowship and friendship and good food. And so be on the lookout for that. And as always, if we can do anything to help you or someone you know, please let us know, give us a call, email us. And we, again, consider it an honor and a privilege to serve you.
Have a good afternoon.
See ya.
Bye. See ya.
Bye.